Usually a sudden plunge to 59,001 weathers, the lowest point since late 2024, looks like pure chaos. Just
hmm
red candles, panic, people rushing for the exits.
Right, yeah. From the outside, it looks like a system just breaking down.
Yeah, but today in this deep dive, we are moving past that surface level noise to figure out what is actually rewiring the market behind the scenes for you.
Exactly. Because if you really look at the fundamental architecture of this asset class, it's shifting right in front of us.
It absolutely is. I mean, the short-term traders are feeling the pain today, sure, but structurally, this isn't just a blind crash.
No, not at all.
So let's start with the immediate bleeding. We saw a massive deleveraging event, like over $341 million in Bitcoin-specific liquidations. What triggered that avalanche?
Well, it was incredibly aggressive selling. Binance alone saw a $1.06 billion negative cumulative volume delta.
Over a billion. Oh, wow.
Yeah, which, simply put, means institutional desks weren't just passively selling off their holdings, they were aggressively borrowing Bitcoin to short it.
Betting that the price would keep falling.
Placing massive bets, exactly.
And they're doing that because of the broader macroeconomic reality, right? Core PCE inflation just came in at a sticky 3.4%.
Yeah, that's the real driver here.
And since PCE is the Federal Reserve's preferred inflation gauge, that stubborn number basically forces the Fed to project higher interest rates all the way through 2026.
Exactly. I mean, high interest rates change the entire environment.
It's like someone suddenly cranked up Earth's gravity. When the macro environment gets that heavy with high borrowing costs, carrying highly leveraged derivative positions becomes just exhausting.
That gravity analogy is perfect.
Right. Eventually your knees buckle and you get this massive washout.
Yeah, especially when you look at specific corporate strategies. Take Strategy Inc., for example. Their stock is down 81% from its peak.
Wait, 81%? That's brutal.
It is. That's a $25 billion wipeout in the value of their collateral. And why? Because their entire treasury model is built heavily on leveraged swaps and debt.
Right. While at the exact same time, you have companies like Hyperscale Data taking a totally different path.
Yeah, completely different.
They're using real-world revenue from like a massive AI computing contract to buy Bitcoin completely debt-free.
And that contrast is so vital for you to understand. The short-term leverage is bleeding out, but long-term, Wall Street integration is actually accelerating.
Okay, so talk about that integration.
Well, BlackRock is now officially recommending a 1% to 2% allocation in standard advisory portfolios. They even launched the BETO fund, which is an options writing ETF.
Meaning they write covered calls.
Essentially, yeah. They cap their upside potential on the Bitcoin they hold in exchange for generating a predictable monthly yield in fiat.
Wait, I need to stop you right there. BlackRock making a covered call ETF. Doesn't that totally defeat the original purpose of Bitcoin?
I mean, yeah, that's a very fair critique.
It just feels like we're turning a decentralized rebellion into another boring Wall Street dividend stock.
It absolutely looks like defanging the asset.
Yeah.
But to Wall Street, that boring, predictable cash flow is exactly what justifies buying it in the first place.
Ah, right, of course.
And for institutions to park billions in those mundane vehicles, they need the regulatory plumbing to match.
Which brings us to exactly how that plumbing is changing. These markets trade 24/7, but the real structural changes are happening quietly in Washington.
Right. The Fed just dismantled its specialized, highly restrictive crypto oversight unit.
Oh, really?
Yeah, they're moving digital assets into their routine, everyday supervision protocols for commercial banks. It's just becoming normalized.
But normal doesn't mean easy. There is major friction right now. Like, crypto-native trust banks are fighting tooth and nail for these skinny master accounts.
Right. And by getting one of those accounts, a crypto bank could plug directly into the Federal Reserve's FedWire system.
Exactly. They wouldn't have to ask a traditional commercial bank for permission to move money anymore.
Which naturally terrifies the traditional banks. The American Bankers Association is actively lobbying lawmakers to block that non-bank access to federal payment rails.
Citing strict capital liquidity mandates, I'm sure.
Well, definitely. And meanwhile, over in the Senate, the Clarity Act is completely stalled because law enforcement is pushing back on KYC rules. They're trying to figure out how to track illicit finance on decentralized infrastructure.
So look at this from a distance. Do you really think traditional banks are fighting crypto's access to federal payment rails out of a noble concern for systemic risk? Or are they simply trying to protect their own lucrative deposit floats?
Well, it's likely a complex mix of both. But when you pull back and look at all these pieces together, the leverage washouts, BlackRock moving in, the Fed changing its rules, it points to one reality.
The Wild West era is ending.
Exactly. The entire ecosystem is trading wild, short-term leverage for deep, regulated integration.
And that leaves you with a pretty massive question to chew on as we wrap up this deep dive.
It really is.
With Europe's MiCA rules kicking in to force liquidity onto heavily compliant entities, and Wall Street actively absorbing the asset into standard 60/40 templates.
A huge shift.
Is the ultimate fate of decentralized finance to simply be swallowed and managed by the exact centralized institutions it was built to bypass?
That is the multi-trillion-dollar question.
The gravity has definitely changed. We'll see who is left standing.